Welcome to the Opening Bell Report.
Today, we're looking at a really fascinating market anomaly.
Yeah, it's definitely one that catches your eye immediately.
Right. We have a comprehensive analysis report on the table today, and we're going to pull apart exactly how a stock manages to post a massive, a 45.97% upside move in a single day.
It's a huge number.
If you're tracking the ticker, we are looking at the AI microcap stock Gaxos.ai Inc. That's NASDAQ Q ticker GXAI.
GXAI.
Exactly. The stock closed at $1.81 after just a highly violent upside move. Now, this kind of price action immediately grabs your attention, but we aren't here to just, read off headline numbers. The mission for this deep dive is to unpack the mechanics of this surge, because what is happening under the hood here is highly unusual.
It is a perfect setup for us to examine, and I think it's crucial to understand why this specific event matters to you as a listener.
Yeah, why should they care?
Well, this isn't just a story about a microcap having a lucky run on a random Tuesday. What we are looking at in this analysis report is a textbook case study of what happens when extreme technical momentum violently collides with a bizarre fundamental reality.
Bizarre is the right word for it.
Throughout this discussion, we're going to explore the exact anatomy of this technical breakout. We're going to uncover a hidden mathematical safety net that is currently trapping short sellers. And we will debate the realistic price targets laid out in the data.
So whether you're an active day trader managing risk or just someone fascinated by market psychology and all this AI hype, this breakdown offers a masterclass in how modern microcaps behave.
Absolutely.
Okay, let's unpack this. Let's get right into the anatomy of the surge. The technical breakout.
The charts are wild on this one.
They really are. The most glaring event is that the stock completely shattered the 200-day simple moving average.
The 200-day SMA.
Right. And as anyone who watches the tape knows, that 200-day SMA has been acting like a heavy ceiling. Massive overhead resistance for months. It is a very stubborn level to break.
Very stubborn.
To push through that kind of long-term resistance requires an absolute sledgehammer of momentum. You have to absorb all the legacy bag holders who have just been waiting for a chance to sell at break-even. The analysis report makes it clear you don't just drift above the 200-day SMA, you have to blast through it.
And the sheer force of that blast is what makes this actionable. To understand the legitimacy of this price action, you really have to look at the volume profile.
The volume was staggering.
It was. The analysis report points out that during this single session, the stock traded over 218 million shares.
218 million.
Yes. And to really put that in perspective for you, consider the stock's average daily volume. It normally sits around a relatively quiet 7.8 million shares.
So 7.8 million up to 218 million.
We are talking about roughly 28 times the normal average daily volume. That completely dwarfs normal trading activity.
Yeah, that's not just a few people on a message board.
Exactly. This isn't just a handful of retail traders coordinating a quick pump. Volume of this magnitude signifies massive institutional participation or heavy involvement from large retail syndicates.
And we should clarify for the listener, this is absolutely not a low-float anomaly.
Good point.
We see those all the time, right, where a company has a tiny supply of tradable shares. So a little bit of buying pressure creates an artificial temporary squeeze that just reverses the next day.
Right, those burn out fast.
But 218 million shares changing hands means there is deep, sustained liquidity flowing through this ticker. It's a tidal wave of capital. And because of that volume, the data shows both the 50-day and that heavy 200-day SMA have officially flipped.
The trend has changed.
Yeah, they've gone from being a ceiling, overhead resistance, and a bearish trend to acting as a floor. Bullish dynamic support.
Which is the exact structural shift technical traders look for. But I want to add some friction to this bullish picture.
Oh, here we go.
Because there is a vital nuance in the technical data. Because the surge was so fast and violent, the relative strength index, or RSI, has spiked above 70.
The overbought dilemma.
Precisely. Traditionally, when you see an RSI over 70, the asset is considered technically overbought. Conventional wisdom tells you that's an immediate red flag, a signal that the stock has run too far, too fast, and is due for an imminent, sharp pullback.
Right. But I would argue that conventional wisdom often falls apart in the microcap space.
It does.
The analysis report clarifies why that overbought signal isn't necessarily an immediate death knell here. When you are dealing with a microcap that has fresh catalyst momentum, especially something tied to AI right now, those stocks can stay in overbought territory for extended periods.
The normal rules of technical gravity are temporarily suspended.
Exactly. Suspended when the volume profile is this overwhelming. You can't just short it blindly because the RSI hit 72.
You will get run over trying to fade a 218 million share breakout based solely on an RSI reading.
Yeah, you will.
And that brings us to the most compelling part of this entire deep dive. Usually, when you see a company surging on AI and defense buzzwords, you assume it's a castle built on clouds.
All hype, no substance.
Right. All hype, terrible financials. But when we look at the fundamental floor laid out in the analysis report, the actual foundation of this rally is bizarrely grounded in the balance sheet. It is a complete paradox.
Here is where it gets really interesting.
Yeah.
The technicals are screaming buy, but what happens when you actually look under the hood? The numbers here show us a very compelling, if strange, story. First, we have a massive cash buffer.
Both the other numbers.
GXAI currently holds roughly $1.52 in cash per share. Second, the company operates with zero long-term debt.
Zero debt.
Zero. So you have $1.52 in pure cash for every single share outstanding and no debt eating into it. And third, because of those two factors, we have a massive disconnect in the enterprise value.
Let's break down that disconnect because it is the key to understanding the psychology of this trade. The total market capitalization of the company is hovering around $15.7 million.
Okay.
But when you subtract that 1.52 per share cash position from the market cap, the actual enterprise value of the underlying business is sitting at just $2.29 million.
I want to make sure we are all fully grasping the math on that. The market is essentially valuing the actual operational AI and defense business at just over $2 million.
While the company sits on a mountain of cash.
Right. And this brings us to what the analysis report calls the trampoline effect. The stock closed at $1.81. The cash per share in the bank is $1.52.
Those two numbers are incredibly close to each other.
They are.
And mathematically, that proximity cushions the downside. Think about it from a risk assessment standpoint. If you buy a stock at $1.81, your absolute worst-case scenario is usually the stock going to zero.
Losing it all.
But here, the company physically has $1.52 per share sitting in a bank account. The stock price can only fall so far before it hits the literal cash liquidation value of the company.
So it acts as a fundamental trampoline.
Exactly.
Oh.
If the price drops down toward $1.50 or $1.40, value investors, specifically those looking for classic net-net plays, will theoretically step in to buy that cash at a discount, which bounces the price back up.
And bringing this directly back to you, the listener, why should you care about this trampoline? Because this mathematical cushion explains exactly why momentum buyers feel so emboldened to chase a 200-day SMA breakout.
They feel safe.
They know the floor isn't a bottomless pit. It's right below them at $1.52. But more importantly, let's look at what this does to short sellers.
It's a nightmare for them.
Imagine trying to bet against this massive technical breakout. You might be totally right that the AI pivot is pure hype, but your downside target is severely limited by that giant mattress of cold, hard cash. It essentially traps short sellers who are trying to bet against the momentum.
It's a structural trap. Short sellers are trying to fade a technical breakout, but they are running headfirst into a balance sheet that refuses to budge. The volume is pushing up, and the cash floor is preventing a collapse down.
It's quite the battlefield.
It really is. And that intense fundamental tension leads us right into the scenario analysis. The data maps out three very distinct paths for how this immediate technical battlefield could play out over the coming days.
Let's guide everyone through these scenarios, starting with the bull case, the upside.
The immediate upside target level here is a range between $2.43 and $2.52.
Okay.
The condition for this is pretty straightforward. The current momentum simply sustains itself. The stock clears its recent intraday high of $2.43 and pushes toward the Wall Street one-year consensus target of $2.52.
But there is a major caveat in the analysis report for this one.
Yes, there is.
For this to happen, the company must maintain a continued flow of public relations announcements regarding its AI and defense acquisitions. It needs that PR flow.
And that caveat is exactly why you have to be careful. If the bull case relies entirely on a steady drip of press releases from the company's marketing department, That is a fragile foundation.
It really is.
It means the stock isn't climbing on actual revenue generation. It's climbing on the promise of future news. However, in the microcap momentum space, narrative often dictates price action more than immediate revenue.
Very true.
As long as the PR flow keeps the retail syndicates engaged, that buying pressure can easily absorb the profit takers and push it to that $2.52 level.
That's a fair point on narrative driving price, but let's look at the absolute best case scenario, the blue sky maximum.
The fun one.
The fun one, exactly. The analysis report outlines a blue sky maximum target of $2.96.
That's a big jump.
It is. That would be a full retest of the stock's 52-week high. Getting from upper already 1 cent all the way to almost $3 requires more than just a few press releases.
Oh, absolutely. To hit that blue sky target, you need a structural compounding effect. Specifically, we have to look at the short interest, which currently sits at roughly 3.77%.
Which doesn't sound like much.
On a large cap stock, 3.77% short interest is nothing. But on a microcap that just traded 218 million shares in a single day, those shorts are feeling immense pain.
They trapped against that cash floor.
Right. And if they panic and are forced to cover their positions, meaning they have to buy shares at market price to close out their losing bets, that creates a violent secondary wave of buying pressure.
So you're essentially banking on a short squeeze to ignite the final leg up.
Exactly. And the data notes this scenario becomes highly probable if it coincides with a broader, sector-wide rally in small-cap AI stocks. If the entire sector catches a bid and the shorts are forced to cover simultaneously, that provides the rocket fuel required to propel GXAI to that $2.96 level.
A short squeeze combined with a broader sector rally is definitely a potent mix. But let's play devil's advocate here. Well, it brings this whole thing crashing down. We have to look at the bear case impartially.
We do.
The downside target level outlined in the report is a reversion drop back to the range of $1.30, down to $1.24.
Which would effectively mean the breakout fell.
Right.
The condition for this bear case is that the massive retail and institutional momentum we just saw simply dries up. The volume vanishes, the broader market loses interest in the AI narrative, and the stock gaps down to fill the void left by the sudden surge.
And let's be clear about what catalyzes that gap down. It happens when the market suddenly wakes up to reality of the company's heavy cash burn, which brings us to the final verdict. Because there is a massive tug of war here between the reality for a momentum trader and the reality for a long-term investor. So what does this all actually mean?
The distinction between those two realities is everything. Let's look at the trader's view first. The analysis report confirms that breaking the 200-day SMA on 28 times average volume is a highly actionable, legitimate technical event.
The volume validates it?
Yes. The momentum is undeniably bullish right now. The actionable advice here is that the trend is your friend until it bends.
Classic.
For active traders, the immediate test is whether GXAI can take its intraday consolidation zone around $1.75 and turn it into ironclad support. If $1.75 holds, the trader's thesis remains intact and they will ride the trend.
But then we pivot to the investor's grounding. This is the final reality check from the text. While traders are riding the volume wave, long-term investors have to remain grounded and look at the underlying business mechanics. Yes, there is $1.52 per share in cash acting as a trampoline right now, but this company is fundamentally a cash-burning machine.
It is.
The data states they are operating at a negative 543% net profit margin.
We really need to pause on that number.
A negative 543% margin. That means for every dollar they bring in, they are burning a massive amount of capital just to keep the lights on. If you are a company trying to pivot into highly capital-intensive sectors like artificial intelligence and defense contracting, that cash burn is only going to accelerate.
And that is the ultimate reality check provided by the analysis report. We must be exceptionally clear-eyed about what this asset is.
Yeah.
This current rally is a momentum trade. It is fueled by trendy buzzwords, an incredibly tight enterprise value, and a massive technical breakout. It is absolutely not a reflection of sudden underlying profitability or a miraculous turnaround in their core business model.
The math doesn't support that.
No, it doesn't. The company is burning cash at an astonishing rate. And while that $1.52 clank cash cushion is acting as a safety net today, a cash-burning machine will eventually eat through its own floor if it doesn't figure out how to generate a legitimate profit.
It's a ticking clock, a company slowly eating through its own safety net. I think that perfectly sums up the incredible tension we've explored in this deep dive.
It's a fascinating dynamic.
On one hand, you have this microcap AI stock caught in the grip of explosive volume-backed momentum, blasting through technical resistance. On the other hand, you have the harsh, sobering reality of a negative 543% net profit margin. And sitting right in the middle, stabilizing the whole volatile situation, is this bizarrely high cash per share ratio that is trapping the short sellers and emboldening the momentum buyers. It is a true anomaly.
It is an anomaly, and analyzing something like this leaves us with a lot to think about regarding the current state of the market.
What are you thinking?
Well, I want to leave you, the listener, with a final lingering question to ponder on your own. It builds on the data we've unpacked today, but pushes into some broader implications.
Let's hear it.
If a microcap company can trigger over 200 million shares in trading volume simply by having a cash cushion and utilizing the right AI and defense buzzwords, what does that actually reveal about the broader market's current appetite for risk? Are we currently navigating an environment where traders are essentially valuing the mere vocabulary of innovation over actual functioning business mechanics?
Wow. Valuing the vocabulary of innovation over actual business mechanics. That is a brilliant framework to view this through, and it perfectly captures the wild era of the market we are currently in.
It certainly feels that way right now.
It really does. Thank you for joining us on this deep dive. Whether you are actively trading these technical breakouts or just analyzing the chaos from the sidelines, we hope this breakdown has given you a much sharper lens to view the market through. Remember to look past the momentum, check the balance sheets, and keep questioning the numbers behind the hype. Until next time.
Don't forget to like, share, and subscribe for more.